Have you ever wondered how financial markets work? This vast, intricate network is like the bloodstream of the global economy. It's where buyers and sellers come together to trade a variety of financial products, and it plays a pivotal role in steering the course of economic progress. Imagine a bustling marketplace, but instead of fruits and vegetables, people are buying and selling stocks, bonds, derivatives, mutual funds, and exchange-traded funds. Each product serves a unique purpose and carries its own risk and reward profile. Some are straightforward, like stocks representing a slice of ownership in a company. Others, like derivatives, are more complex, deriving their value from underlying assets. These financial instruments are the building blocks of portfolios, helping individuals and institutions alike to invest, save, and plan for the future. So are you ready to dive deeper? Join us as we delve into the world of financial markets and unravel its complexities. Let's begin with one of the most well-known financial products, stocks. So, what exactly are stocks? They are essentially pieces of ownership in a company. When you buy a stock, you're purchasing a small part of that company, making you a shareholder. But why do companies issue stocks, you may ask? Well, the primary reason is to raise capital. This could be to fund new projects, pay off debt, or expand their business. By selling stocks, companies gain access to a large pool of funds without taking on additional debt. Now let's shift gears and look at it from an investor's perspective. How do investors make money from stocks? There are two main ways. First, through dividends. These are payments made by the company to its shareholders, usually as a distribution of profits. If the company you've invested in is doing well and making a profit, you as a shareholder may receive a portion of those earnings as dividends. The second way is through capital appreciation. This occurs when the price of the stock increases. If you bought a stock at $10 and it rises to $15, you've just made a $5 profit per share if you decide to sell. But remember, stock prices can also fall, so investing in stocks does involve risk. So, what role do stocks play in financial markets? They are a crucial part of the market, providing a platform for companies to raise funds and for investors to become part owners in those companies. They facilitate economic growth by allowing funds to flow from those who have excess capital to those who need it. Moreover, the performance of stocks often reflects the overall health of the economy. When companies are doing well, stock prices typically rise, signaling economic growth. Conversely, falling stock prices may indicate an economic downturn. So, stocks provide a way for companies to raise funds and for investors to potentially profit from the company's success. Remember though, investing in stocks should be based on careful research and consideration, as it does come with risks. Moving on to another crucial component of financial markets, bonds. Let's dive right in. What exactly are bonds? In the simplest terms, a bond is a loan made by an investor to an entity. This entity could be a government, a municipality, or a corporation. When you buy a bond, you're essentially lending money to the entity for a specified period. And in return, they promise to pay you interest at fixed intervals and return the principal amount on the bond's maturity date. So, why do entities issue bonds? It's a strategic move. Entities issue bonds to raise capital for various purposes, such as funding ongoing operations, undertaking new projects, or refinancing existing debt. It's a win-win situation. The entity gets the funds it needs, and you, as an investor, earn interest. But how do investors make money from bonds? Well, there are two ways. First, through the interest payments, also known as coupon payments, received during the bond's lifespan. Second, if the bond is sold before its maturity at a higher price than it was purchased for, the investor can make a profit. This is known as a capital gain. Now, let's talk about the role of bonds in financial markets. Bonds are considered safer investments compared to stocks because they offer a more predictable income stream. This is because the interest rate and the repayment schedule are both set in advance. Also, in case of bankruptcy, bondholders are paid before stockholders. This makes bonds a preferred choice for conservative investors who prefer steady returns and lower risk. But remember, bonds are not entirely risk-free. There's always a chance that the entity might default on its payments. Therefore, it's crucial to consider the creditworthiness of the entity issuing the bond. Bonds, therefore, offer a more predictable income stream for investors while allowing entities to raise capital. As you delve deeper into the financial markets, you'll find that bonds, with their balance of risk and reward, play a vital role in any well-rounded investment portfolio. Next, we venture into the intriguing world of derivatives. Picture a bustling marketplace, not of goods, but of contracts promising future transactions. This is the world of derivatives. A derivative, at its core, is a financial contract whose value depends on or derives from the value of an underlying asset, such as a stock, bond, commodity, or even a currency. Think of it like a bet on the future price of that asset. You're not buying or selling the asset itself, but a contract that gives you the right or obligation to do so at a future date and at a predetermined price. Now, why would anyone want to do that? Well, derivatives play a crucial role in the financial markets for two primary reasons: risk management and speculation. Let's start with risk management. Imagine you're a farmer and you're worried that the price of wheat might fall before the next harvest. To protect yourself from this risk, you could enter into a derivative contract known as a futures contract, agreeing to sell your wheat at a fixed price at a future date. If the price of wheat does fall, you're covered because you've locked in a higher selling price. On the flip side, derivatives are also used for speculation. This is where investors aim to profit from price changes in the underlying asset. For example, a trader might buy a derivative contract, expecting the price of the underlying asset to rise. If the price does rise, they can sell the contract for a profit. However, it's important to note that while derivatives can be used to hedge risk or speculate, they can also amplify risk. This is because derivatives often involve leverage, which means you can control a large amount of the underlying asset with a relatively small amount of capital. This makes derivatives a double-edged sword. On one hand, they can provide significant returns. On the other, they can lead to substantial losses. Derivatives, although complex, are powerful tools for managing risk and leveraging investment strategies. Lastly, let's look at mutual funds and exchange-traded funds, or ETFs. Mutual funds are essentially a pool of funds collected from multiple investors, which are then managed by professional fund managers. These managers invest the pooled money into a variety of securities, such as stocks, bonds, and other assets based on the fund's investment objective. For example, an equity mutual fund will focus on investing in a portfolio of stocks. The beauty of mutual funds is that they allow investors to gain exposure to a diversified portfolio with a relatively small investment. Profits or losses are then shared among the investors in proportion to their investments. On the other hand, we have ETFs. These are similar to mutual funds, but they trade on stock exchanges just like individual stocks. This means they can be bought and sold throughout the trading day at fluctuating prices, unlike mutual funds, which are bought and sold at the end of the trading day at a fixed net asset value, or NAV. ETFs can be quite diverse in their holdings, tracking anything from a specific index, like the S&P 500, to a particular industry or sector, or even a commodity like gold. This makes them a flexible tool for investors looking to target specific market segments or implement more complex strategies. So what role do these investment vehicles play in financial markets? Well, mutual funds and ETFs provide an important avenue for both retail and institutional investors to diversify their portfolios and manage risk. They allow access to a wide range of assets which might otherwise be out of reach for individual investors. Additionally, because they are managed by professionals, they can be a good option for those who don't have the time or expertise to manage their own investments. In conclusion, mutual funds and ETFs are powerful tools that can help investors achieve their financial goals. They offer a level of diversification and professional management that can be hard to match with individual securities. Mutual funds and ETFs offer investors a way to diversify their portfolios and access a wider range of assets. Let's recap what we've learned today. We dove deep into the world of financial markets and unraveled the secrets of various financial products. We started with stocks, the ownership certificates of a company, which play a crucial role in raising capital for businesses. Then we moved on to bonds, debt instruments that governments and corporations use to generate funds for various projects. Next, we ventured into the complex yet intriguing universe of derivatives. These financial contracts derive their value from underlying assets and are mainly used for hedging risks or for speculative purposes. Lastly, we explored the realm of mutual funds and ETFs. These investment vehicles allow individuals to invest in diversified portfolios without having to buy each security individually. Understanding these financial products can help you navigate the financial markets more effectively. Thank you for joining us on this journey through the financial markets. Stay tuned for more enlightening discussions on finance.